only 82 permits have been issued out of the 7,000 homes that burnt down in the Palisades.
Yeah, like you guys already, that was national news, right?
Mm-hmm.
Not surprising to anyone, not surprising to anybody in the business, but because I've been through this, right?
Yeah.
I've had hurricanes, we've had fires, and the process of getting through first the cleanup, then the insurance piece, negotiating with them, and then all the code updates. Like, so for example, sprinklering a house, which is so basic now. Like all new houses are supposed to have sprinkler systems, for fire suppression. Well, that happened somewhere in the 80s, 90s. So if the homes before that. So there's all these things that you don't think about, just trying to rebuild something that you might have had before.
Yeah, and it's 1.2% of the homes. And I mean, it's been, when did the fire happen? Oh, I think it was a
few years ago, or a couple of years ago, actually.
I don't.
But, we should probably know this.
Look, I think it was not even a year ago, but I could be wrong. Palisades.
Jerry, you're going to have to splice this
date. January 7th of 2020.
Okay, so would have been not even a year, less than a year, right?
Yeah.
Okay. Yeah.
So it's been less than a year ago, but almost a year ago, by a few months, and we're only having 1% of the permitting done. And, those people probably knew someone that knew someone that knew someone.
But, this is a common issue, right? Like I think, obviously it's getting a lot of press now because it's such a big deal and it wiped out so many homes.
Mm-hmm.
But this is an issue, whether it's one home or thousands of homes. The exact same issue we have in Hawaii, right? The exact same issue we've had in other fires in the Malibu area. So this is common.
Yeah, but let's look at that. So you had the Paradise Camp Fire in 2018,
yep,
and that destroyed 14,000 homes. 6 years later, fewer than 40% have been rebuilt.
Okay, before we jump right over that, because I know you have more lists.
More data.
Okay. 40% of the homes have been rebuilt. 40% of the 14,000 homes. 6 years later. Okay. Mm-hmm. That is the point. Think of that. That's insane, right? So this is why insurance is so important, right?
Right.
Like you guys, if you, we're not going to go down an insurance rabbit hole here, but just know that these are questions you should ask, things around replacement costs, things around permit requirements, things around code changes. Like all of those things are battles I've been through on the apartment side. So, and if you're just a homeowner sitting there and you're doing your thing and you think you're covered, these are things you probably should be looking at.
Yeah, and in Hawaii, the Malibu, or what was it? Not the Malibu fires, but the Lanai fires. They only have a couple dozen homes rebuilt, and that was from like 3 years ago.
Yeah, so Hawaii, there's just a few dozen.
So wait, for these people, when they're in these areas, I know you don't like to live in areas that are high risk like this because of all of this craziness that goes on. But would people be better off if their house burnt down to have just listed it, or does that not make sense because the land's not really worth much?
Well, there's politics at play, right? So we have friends in the Malibu area, for example, where they're along the coast. Mm-hmm. Well, then there's I think it's called the Coastal Commission, does not want those houses rebuilt, right? Right. So you have that. So it's all governmental restrictions, right? And so I think at the end of the day, it's a combination. How hard is it going to be to rebuild what you had? Right. That could take years. I have a friend that, he was uninsured. Let's don't forget about those.
Right.
Like some of these could be uninsured.
Yeah, but most of them aren't.
I know, but I'm telling you, in some of the really expensive homes along California, I think because of the cost of insurance, certainly, we know that's the case in Florida. We have friends in Florida that, basically said they're not going to rebuild, right? As a result of a different issue, which was the hurricanes and the sand and the flooding and all that, right? Mm-hmm. So
what do you think is a smart financial move? I mean, if your house burns down, would it be to sell the land that it's burned down on, or would it be to
price of the land?
That's what I mean.
Well, right. No, but you can't answer the question. it's an obscure question without knowing the facts. It depends on what the price of the land is. Would I sell something for the price of land when I had a house on it before? Probably not.
Okay. So
Would
you would
you?
wait.
Would you?
Well, I don't know. It depends
Like,
if it's just
okay,
going to
well,
cost
let's
me to
just talk about our house. If our house burned to the ground, would you sell it for the price of the land?
Well, if sure insurance told me that it was only going to give us half the value of what it's going to cost to rebuild it, because they don't necessarily rebuild it to their full cost. You have a cap on your insurance. Everyone's different.
I think it's just a personal decision, right? Like, are you going to take a 50% haircut, right? Like, and what if you still have a mortgage? What if the mortgage is more than the land?
So how does that work if the mortgage
has nothing to do with.
Well, you would bankrupt on it if or whatever.
Right. There's all that.
Well, because I think what people don't understand too, and our friends the Fetkeys talk about this, is most people are underinsured, and that's why you should look at your policies, because your replacement cost, you might only have $1 million in replacement cost, and your house might cost $5 million to rebuild.
By the way, they're in Malibu, and so we were having chats with them about this exact issue, right? And insurance is super expensive now. And by the way, if you have a loan, the lender's going to require you to have insurance, right? And the lender, a lot of times, I'm sure the lenders are pulling out their legal and saying, we need to dig into these insurance policies to make sure that our loan is covered. Because if there's a loan on a property and they're going to your point, they're just going to give you the land value, the loan's not going to get paid back.
Right.
So you're out completely. All your equity's gone, and the insurance proceeds are just going to be pay off the loan. So in that particular case, using that example from your question, the answer would be no.
Yeah, I was just curious, like what you normally would do, because you have all these people that are waiting. You had a lot of people that moved to Arizona and other parts of California because the Palisades is basically uninhabitable. I mean, you can't live there.
I'm sure there's a cash out, for a lot of people. I'm sure. I mean, if somebody a lot of people are renting in Arizona. A lot of people bought in Arizona. I know that for sure, because we know some of them. They got affected, and they went somewhere, right? Because they had to put their kids in schools, and there are all kinds of stuff. There, life goes on.
Well, it does go on, and if it's going to take, if it's been 9 months and they only have a few houses permitted, 82 houses permitted, then for them to rebuild it all, I mean, it'll be 10 years before the Palisades is back to anything that it was.
At least, and that's if you even want to go back. I mean, if you're building a home, and the homes behind you and to the right and to the left of you still are charred and dealing with insurance, what's the real value of your home?
Right. But also, if you have kids or even you yourself, after 10 years, you're going to have a life somewhere else, most likely.
That is the issue. What I heard immediately after, specifically the one in California, was that people had issues around their children. It was all about getting the kids back into school, right? And not as much about the job, because you can do that kind of remotely, and there are ways. But if you have other ties to the community and you're challenged there, then you're probably going to relocate.
So maybe that was a better question: is say that was your house and it happened to you. Would you just assume you were relocating? Or
no, I wouldn't, at this point, right? But I'll think about our situation. If I had kids in the local school and that school burned down, because that's what happened in some of these cases, I have to figure out where I'm going to put them into school, right? So I'm looking at all my options. Maybe I'm moving, just outside of the area that was burnt. I'm sure a lot of people did that. Then that burdened the schools and drove up the prices, I'm guessing, into those neighborhoods. But then I'm also looking at other options. I'm like, well, do we really want to stay in California as a result of this? Do I move to Arizona? Do I move to Florida? Do I move to Texas? All those things are options for people. And really, it has a lot to do with, just getting their lifestyle back to the way it was.
Yeah, it's not necessarily just a California issue. I know we bash on California on here, but, just with anything, like you said, you have new zoning, you have new building codes. You're not going to want to build the same materials that were built before.
No, they can't.
It's toxic. The whole area is toxic.
They have height restrictions. They have setbacks. So setbacks are reducing what they call the building envelope, because for all kinds of reasons. I mean, what's happened in, especially in some of these older houses, especially the ones in Malibu, the ones along the coast, those are built in the 40s, 50s, 60s, 70s. They're so different now, right?
Mm-hmm.
And the codes are so different. And the reality is the houses that are being built today are significantly safer.
Yeah, absolutely.
Right.
And when you're in a fire zone, you're going to want to build to help fireproof your house. If you're in a hurricane zone, they want you to build to make it hurricane proof. Like our friends that live in Florida were telling me they want all of the homes on stilts, along the coastline. And then they want what they call hurricane windows so that they don't, get blown in with all the wind.
And cylinder block, as opposed to drywall, because drywall gets mold in it. So there's what happens is, if you buy something older and it gets damaged, you have to basically build it to today's standards. And then they look to the insurance policy on whether or not that even is included.
Right.
Right.
Absolutely.
So that's the issue. And then there's just think of all the laws that have changed in the last 50 years, or 40 or 30 or whatever it is. And I know those because we're constantly building apartments, right? And so all that stuff is a battle. And they're in the nuances of the insurance policy. And that, I think there's a group called public adjusters that people reach out to, and they're basically lawyers that dig into all the different kinds of language inside of an insurance policy. Those guys are busy right now.
Yeah.
Really, really, really busy. They basically represent the homeowner and fight for you, because let's face it, when you buy insurance, you're buying it from essentially a commission salesperson.
Mm-hmm.
That, they might know a little bit about the policy, but the depths of the policy are not in that 1 or 2 pages that they give you as a summary. Right. There's a whole bunch of legal language behind all that stuff. And that's really probably what's happening right now.
Yeah. And there's a pro tip, because I used to work in insurance, is, if you have questions about your policy, put it in writing and send it to your broker. And, not after something happens, but before. And, there's something called error and omission insurance. So if they tell you that it's covered and then it ends up not being covered, their error and omission insurance does cover it.
And one other thing is, like, let's say you have an insurance policy, let's say in California, and your house burns down. The policy and the proceeds of the policy, what are they for? They're for you to rebuild it. They're not for you to just put in your pocket. Like, that's not the point of insurance.
Yeah,
right?
They don't let you do that.
Correct. So back to your original question. Can you take insurance proceeds and walk?
Oh, no, I don't think you
exactly my point. Mm-hmm. Right. So then it has to be built, right?
Mm-hmm.
So, it's just, there's all these things that, are really, really, really important. But the reality is, if, based on these facts, there's only half a dozen homes, or 7 homes, was it? That
82 permits?
There were only 82 permits in less than a year out of 14,000.
Yeah, and only, I said, a couple dozen homes built in Hawaii.
A couple dozen, that was it, yeah.
That are built.
That are actually built. Yeah, so those are not good numbers, right? Especially if you lived there.
Yep, absolutely. So rates decreased slightly.
Yeah, a little bit. Yeah.
They're anticipating the Fed to decrease them.
I don't know though. There are a couple things inside the inflation rate that potentially look like, I think it's the one that Jerry, is that called PPI, the consumer price? Yeah, the PPI. Yeah, the producer price index actually was up. What that is it's the components, and it's a little bit different than the CPI, but the PPI was actually up, and so that's kind of raising some eyebrows. And then also unemployment kicking up, right? So it'll be interesting to see. The Fed is going to be meeting here in the last half of this year, but I think the reality is, guys, if you're making on a quarter point here and a quarter point there, that's probably not the right thing to focus on. So let's just say that the Fed lowers a quarter point for the next few. It's really not going to move the needle that much. Like a half a point to 3/4 of a point, it'll definitely move the needle a little bit. but it's not going to move it that much. Trump even said he wants 3 percentage points.
I know, but I think that does a couple things. One, I think when you're looking at buying a $600,000 house, a quarter or half a point does change your payment by a few $100s a month. And then secondly is I think it's more of a signaling to buyers that rates are dropping, right? And they've learned it's better to be on the beginning of dropping rates until they drop 3% and then prices shoot up, right? So I think there's a lot more activity going on. I actually did my first escalation clause that I've done in a long time. And we did not get it.
I know.
I have
You lost the deal.
About
Yeah, that's the other side of it. Like there are markets that are still hot.
Yeah. And I mean, we bid 10,000 above asking on an escalation clause, and they went with another offer, and that was offering the day it went live. So it's not
of last week, by the way.
Yeah, so it's not like, but then even more so than that. I mean, I've been sending people homes, and the next day they're under contract. So I do think I have seen personally the market picking up based on these cuts because things have been sitting. And this cut has got them to move. And for those thinking rates have not been cut yet, I think the mortgage companies are assuming they're going to be cut. So rates have went down a little bit, over the past few weeks.
Yeah. I don't know. I think I obviously tend to look at it more on a commercial standpoint, right?
Yeah. Well, you're looking at a different rates than I am.
So a quarter point here, a quarter point there, it helps, but it's not going to be that significant. And don't forget, there's a tremendous amount of people that pay cash and don't have any mortgage at all. There's an even bigger percentage of people that actually have rates below 4%.
Yeah.
So there's a massive gap between you. There's a massive gap before you actually really even get to that. Right.
Yeah, and if you do look though, refinances are up 23% in the last month.
Yeah, but from what? Like from 10 to 12?
No, but what I'm saying though is these, you laugh, but these rate cuts are substantial for people because their mortgages are so high.
Well, yeah, I suppose that is true. I mean, there's no question that a little bit of rate relief is going to spur stuff, right?
Mm-hmm.
For sure. But I just don't think it's going to move the needle like people think. It's got to be significant for this to really take off. It's got to be significant, and we're a good year and a half from that. Powell's going to dig his feet in all year. We've already seen that at least through because Trump's pissed him off, right? And so I just don't think.
Well, you say a year and a half, but in 9 months, Powell's gone.
9 months, Powell's gone, new person in, but then what? Then it's going to take at least 3 to 6 months before you even feel the effect. So that's why I say that. That it's next May that Powell moves over and there's a new person. So even if the person, which they won't, is in that role, does something in the first few months. Now I
think they will.
And you're going to say they're going to lower rates in the first week that they get appointed.
You know why? Because Trump likes to be grandiose, and what's more grandiose than electing somebody and they drop rates 1.5 points?
Yeah, but let's get there's what 13 people on the committee.
Yeah, but doesn't he get to pick the 13 people too? Or
no, just the chair.
And does the chair pick the people?
And so
or no?
Powell moves on to the committee.
Okay.
So, this is, and if you guys really want to dig into this, go to what's called dot plot, DOT-PLOT. And it actually shows, because it's the way it should be. The committee is divided, just like the country, right? There's different people have different views on this stuff. So, and so like anything, obviously he's going to try to pack the committee. So let's talk about the way that the Board of Governors at the Fed is made up, because I think this is important.
Mm-hmm. Yeah. So basically, you have the chair that is elected by the president, and then every single board, the board has 14 people. They have terms, 14-year terms. And then so they are appointed also by the president as their terms expire. But they don't all expire at the same time because they don't want the Fed to be very politically motivated, since the president is the one that nominates them.
Right. So the chair of the Federal Reserve has a 4-year term, and then the Board of Governors has different terms. But what was the irony is that Chair Powell is actually appointed by Trump.
Exactly. Yeah, that is.
And now it's pissed at him. So it doesn't always work out. But, they're also protecting themselves because the feds gets a lot of heat, right? And so I think, and we've got out publicly and said this, it's possible that they're hedging because they want to see if the tariffs show up. Because if I'm Trump, and I want a smokescreen for my tariffs on inflation, I'm gonna want the Fed to lower rates because lowering rates will create inflation. It'll create a lot of buying, and it typically drives prices up. You guys have seen that over and over and over and over and over. So lower cost of capital makes people finance stuff. And then, of course, we see sometimes a temporary, sometimes a longer term jump in the values or the prices, right? And so that could happen. So let's talk about what could happen under a Trump-appointed Fed chair. Like, I think that's important, right?
Yeah.
What do you think?
Well, I think the Fed chair is highly influential. And I also think that there is a case to be made for lowering rates if things look like they do now or worse, right, in the job market. And as we all know, Trump is pretty persuasive.
But people are worried because the Fed is supposed to be independent, right? And so I think this administration is blurring the lines here, right? And that's actually what people don't want. What they want is the Fed to be independent of the president being able to tell them what to do. And that's the political battle that we've been seeing in the press, essentially. It's supposed to be.
Yeah, it will be very interesting to see what they do. I just do think, though, that even these small rate cuts, at least on the short term, are going to make a difference. Now, whether they last on the long term, if rates don't continue to get cut, it will remain to be seen.
Yeah, we'll definitely be able to see that here. Who knows? But I think so far we have not seen anything meaningful on the tariffs so far, right?
That's true. But I think that, the Wall Street Journal just came out this week and said that, we can expect issues from the tariffs to arrive in the next few months, not immediately.
Yeah, that's what everybody's been saying. I don't know if the narrative's just kicking it down the road. Who knows? But I think the wild card is still this unemployment issue, with AI. I really do. And it's slowly creeping up. And so we have the PPI, certainly, which we already talked about, which is up. That's typically an early indicator of a CPI that's also up. So the PPI is up and unemployment's up. That's why I just don't see the Fed doing anything aggressively here this year, personally. They might do a little bit here and there, but I just don't see it. So one of the things that is passed and is expected to be inflationary is this big, beautiful bill, right? And inside of it is the 1031 language, right? And so it's going to be interesting for you guys to hear from our next guest, Scott Saunders, talk about that directly.
Well, welcome to our podcast. I'm here with Scott Saunders. He's been doing 1031 exchanges for 37 years. So if there's somebody that you want to learn from, it would be him. So welcome, Scott.
Great to be here with you. This is awesome.
Okay, so raise your hand if you've done a 1031 exchange. You might want to do one in the future. Okay. So they can go really smoothly or they can not go smoothly at all, speaking from personal experience. So Scott, what is the biggest mistake you see investors make with 1031s?
So the biggest mistake, it's really kind of interesting. Most people, when they're doing a 1031, focus on the asset they're selling, right? That's their focus, is to sell it. What you really want to do is put all your attention and your focus on what you're getting into, the new purchase asset. Because the whole goal of doing a 1031 is to upgrade your asset. You might be getting a better return on investment, more cash flow, a better asset, but focus all your attention of what you're going to get into. In my opinion, the property you're selling, it's just a matter of supply and demand. You price it for the market and it will sell, right? So it's not too hard to sell an asset. Put all your attention now to try and line what you're going to get into to upgrade your portfolio. That's really a big missing piece that I think a lot of people don't take into account.
Yeah, and that's kind of what people ask me, because I just did a 1031. And they said, don't you regret not doing that a couple years ago? Because I could have got a little bit more money for the property I sold. And I said, no, because the market was so hot. How was I going to identify what I was going to buy? And then sometimes if you don't identify it in time, you have to overpay for an asset.
Yeah, and that was happening a few years ago. That was the problem. Everybody was selling really quickly, but the demand was so strong, the properties were turning over. It was really hard to lock up a good purchase. So yeah, you got your price on the sale, but now you're scrambling trying to find a good investment. Today, we actually have, I think, one of the best markets for doing 1031s because it's kind of a flat market, and you as a buyer have a little bit more leverage to come in, negotiate, tie up a really good asset, beat up the seller a little bit, get some concessions, get him to do some things. So in my opinion, even though the market itself isn't going off like a firecracker, it's fairly flat, it presents a great buying opportunity for everybody doing a 1031 exchange because you're in a stronger position. You're coming in with equity and you've got a tight timeline. You can get a better purchase opportunity right now in this market.
Yeah, and right now I have a client in the middle of a 1031 actually, and the asking price she wanted was $350, and we got an offer for $310. And I normally you would say no, right? But I was like, well, hold on. Let me see on the property that she wants to buy if they'll do a $40,000 discount, right? And they did. They did a $40,000. So it was like a wash. She basically got full price for what she wanted because she got such a discount on the buy. So there's a lot of wiggle room here. If you guys can identify properties before you even sell yours that you would want to then, once you sell yours, try to negotiate what you're buying against what you're selling.
Exactly. In fact, that's what's a lot of times when I do my own personal exchanges, I'll start lining up what I want to buy before I even list my current property. Now, I may not have it under contract, but I'll be looking at the market, I'll have a good idea, and I might start talking to some sellers. So my focus is on that purchase opportunity and what I'm going to get into, realizing that I know roughly what I'm going to be able to sell my property for. I have a pretty good idea of what I'll sell it for. So all the focus is now on tying up that new purchase that's going to give me a better ROI or help me get closer to my goals faster. So that's the focus.
So Scott, what role does the Delaware Statutory Trust play today? And also, what is it for those that are listening?
Yeah, so a Delaware Statutory Trust, you'll hear it called a Delaware Statutory Trust, which is a long name, but a lot of times you hear it referred to by its abbreviation. It's called a DST. And what it is, quite simply, is it's fractional ownership in a larger commercial property. So they used to be done as tenant in common, or what were called TIC properties, starting in 2002. Most of the fractional ownership today are in a Delaware Statutory Trust. So you can have hundreds of investors going into a much larger asset. Let's say the asset's a $40 million asset, and you're only coming in with $500,000. So you're an investor, and there are a whole bunch of other investors. So that's what a DST is. The opportunity that it provides for you is pretty interesting. It gives you a vehicle to have relatively passive ownership. So with these DSTs, they're put together by a sponsor who's going to make the offering on a PPM, a private placement memorandum. So you'll see what's available. You'll be able to see the tenants that are in there. What are the rent escalators? What does it look like? But that sponsor is now going to manage the asset. So this is a great exit strategy for people that maybe are tired of smaller assets and the hassles of taking care of the tenants and the toilets and the trash and all that, and they want to go into something that's relatively passive. There's a secondary benefit with the DST. When you do a 1031 exchange, you've got a 45-day window from when I sell. I've got till midnight of the 45th day to buy or to identify property. So it's a tight timeline. What's great about a DST is a lot of these sponsors have a portfolio or they have an offering. So you might have somebody who has a DST and there's a whole bunch of offerings that are out there and you're sitting on day 43 getting a little nervous about closing out your exchange. You can call these sponsors that have these, and you can basically identify at the very last minute a slice in that commercial building. So it really gives people a backup solution, kind of something on the back end that if their exchange is struggling, they have a ready source to do that and to go into these DSTs. And these DSTs, to let you know, There are 65 different sponsors. So they're in things like student housing, multifamily, all sorts of different asset classes are now in a DST. One little caveat to be aware of, because we're at a conference here, Limitless, that has a lot of real estate. These DSTs are sold through registered financial advisors. So the SEC considers them a security, yet they qualify as real estate in a 1031 exchange. So most of the time you're going to buy property through a real estate agent or broker. These you're going to get through a registered financial advisor that has the appropriate securities licenses. So it's an entirely different distribution channel, but yet it qualifies for 1031 tax deferral.
So when you're doing a 1031, it's really important that you pick an established company, because what I didn't realize when I did mine is that the money from your sale never hits your bank account, and it can't, because if it does, you'll obviously be taxed on it. So it also doesn't stay with the title company. It goes to the account of the business, right? And it's a little unnerving to watch, 400 grand of your hard-earned equity sitting with someone you don't really know that well. So, Scott, how do you screen a 1031 company?
Yeah, this is probably one of the most important issues that you don't hear talked about all that much, which is the qualified intermediary industry. In the entire country, there is no federal oversight over qualified intermediaries. There's no regulatory body. So they're not under the banking department, they're not under the SEC. It's a completely unregulated industry. So selecting a qualified intermediary and doing a little bit of due diligence, that's really, really important. So I'm going to give you some of the criteria to look at on that. And you want to do this homework. I will tell you, one of the things I see a lot is people don't ask these questions. So let me give you some questions to ask. Number one, are you associated with a larger parent company? Are you a subsidiary of a title insurance company or maybe a bank? A parent company that's got big balance sheet, a lot of deposits. So you want to be with somebody that's a subsidiary of a bigger company. The most important question to ask is, how do you hold the funds? So what you really want is you want your funds held in what's called a fully fettered account. It's a separate account. In the past, and we've had some bankruptcies, unfortunately, that have been fairly significant, the funds that were in some of those pooled accounts, the owner of the company or somebody would take those funds and use them personally, and it left people in a really, really bad spot. So you want to make sure you've got a completely separate account set up, requires your signature to open it up, then your signature to move money out of that account at all times. So that's really important, is how those funds are held. You can certainly look at the bonding requirements, what sort of fidelity bond they have, but realize a qualified intermediary is going to sit on hundreds of millions of dollars, billions of dollars at any point in time. Another resource for you is the National Trade Organization is called the Federation of Exchange Accommodators. Their website's 1031.org, so most reputable qualified intermediaries will belong to that. So 1031.org will give you that. They subscribe to a code of ethics. But that's a really important issue to look at. And I guess the last one I would say is, where do they put the funds? Like, what bank do they put them in? You really, in an ideal world, you want your funds held in a top-tier bank, the ones that are too big to fail, the big names. You don't want your funds in a little local community bank where your qualified intermediary is a big depositor in a little local bank. You want to be with banks like Citibank and JP Morgan and Wells Fargo, those types of banks of that level, because those banks, there's no way they're going to ever fail for whatever reason. No matter what happens in the economy, those banks are going to be around.
So let's talk about the market. So how have the higher interest rates impacted the type of deals you're seeing in the 1031 market?
Yeah, the big impact has really been with the higher rates is that it's slowed down the market. The transactional volume is lower. We just don't see the turnover of people selling assets or acquiring new ones. So the entire market, I call it flat, but it's just we're below our historical levels, certainly for residential, and then certain parts of the commercial market. As we've all heard, aspects of the commercial market are having a lot of distress. People that bought a few years ago on loans or they're trying to refi at today's rates, they're facing some really big challenges. So residential is struggling and kind of wobbling along, and commercial, some segments are booming, some are struggling. What that's done on the 1031 side is what I alluded to earlier, is it's now presenting that buying opportunity, that you're really in a strong position if you have equity and you can qualify for a loan. You're in a better position now as a buyer now, and I think that's the change in the market.
Yeah, and right now, if you're sitting on assets that you think could be optimized, maybe you're not getting the return for all the equity. And I told this story on our show, but Ken had me look at all my assets, and I had a condo that was fully paid off. So when you have a condo that's fully paid off as a landlord, you get your return and you don't necessarily think about it, right? You don't think, what kind of return am I getting? Because you're making money every month. Well, we were doing the math, and my paid off condo I had more equity in that for a lesser return than some of my properties that I had loans on that were at like 2.5%, right? It actually made so much sense for me to sell it and roll it into something that was $150,000 more, but that cash flowed over $1,000 more a month, right? So it's stuff like that. Like, really look, like, between your HOA fees that are going up, or your property taxes, or in the condo space, a lot of these multifamily apartments have brought our rents down because they're brand new and they're amazing and they have vaulted ceilings, and we just can't compete with that, right? So really look at that and look at, is there anything I can roll this into where my return is better? And that's kind of what I did with my 1031.
Yeah, and that analysis that Danille did, doing a return on equity analysis, looking at your portfolio, you might have something that has a good equity position, you think it's performing well, but your return on equity, how hard that cash is working for you, is really not that good. And I'll tell you, I'm a 1031 expert, I'm also an investor, and this is something that a lot of investors do, is they get a little lazy with the portfolio. Over time, it's just building up equity. Going back on maybe an annual basis and looking at your actual return on equity, and then making a decision that I'm going to upgrade my portfolio, right? I've got somebody with a lot of equity, and I'm going to take that equity, and I'll do a 1031 into 2 or 3 assets. That's going to give you more cash flow and a better ROI, and it's really going to help a lot of people that want to get to financial freedom get there faster versus just hanging on to that equity.
We'll take some questions at the end. Okay, so with general wealth planning, how can investors use a 1031 to pass wealth on?
This is the power of a 1031 exchange. This is the best strategy going. So here's what the deal is. When you buy an asset, you've got your original basis. When you do an exchange, you're able to defer paying taxes. And if you do them subsequent over and over and over. So if somebody buys an asset when they're young, in their 20s and 30s, and they start exchanging that, and they go from 1 asset into 2, and 2 into 4, and 4 into 8, and then they take the 8 and they go into a apartment complex, multifamily. When they pass away, their basis goes all the way back to that first purchase they did 30 years ago. So it's essentially all capital gain. Here is why the exchange is such a great strategy. When you pass away, you get what's called a step up in basis to the fair market value at the time you pass away. So if I buy an asset for $100,000 and I do exchanges and now it's worth $10 million later on in my life, when I pass away, my kids get it with a basis of $10 million. So here's the takeaway. I never paid taxes, capital gain taxes, throughout my entire lifetime. And guess what? My kids pay no capital gain taxes at all. So I'm able to use this tool called a 1031 to build wealth, and I'm actually able to take that wealth and I'm able to pass all of it on to my heirs. They don't have capital gain taxes. Now, you have other tax issues, right? There are estate taxes and other considerations to consider. But for the average investor, particularly with the changes in the tax laws, the threshold for estate taxes is much higher now. So the average investor, if they do exchanges right, they can pass on all that wealth to their heirs with a full step up in basis where they don't have to pay any taxes. That is a huge advantage. You can't do that with other investments. I can't take stock and exchange it and not pay taxes. Every time I dispose of a stock or a mutual fund, I have to pay capital gain. Real estate, we got this gift called a 1031 exchange way back in 1921. So it's been around now for 104 years. It gives real estate investors a pathway to build wealth that you just don't have with other financial assets. So really consider taking advantage of it if you haven't. And those of you that are, look at your whole portfolio and go, how can I optimize? I call it curating my portfolio. How can I curate it and get a better ROI and improve my investment position?
So what other considerations should be taken when looking at how to pass it on in your legacy, essentially?
So here's something that's not spot on with 1031, but I think it's really important. When you're looking at passing on an estate and a legacy to your heirs and your children and your grandchildren, part of that is also taking the responsibility to start to train them with everything that you learned to build that portfolio in the first place. And I think legacy planning is just so important that we just don't dump a big portfolio on our kids without preparing them on how to manage it, learning the rules of money, learning how to evaluate real estate, how to manage real estate. So to me, that's a big consideration. And even in my own life, I've started bringing on one of my kids, and they're ghosting me as I communicate with my property manager, and they're reviewing my P&Ls, that I'm starting to do that. And you guys, you can make this kind of fun. On a tax basis, you can put your heirs on your board of directors on your holding company for your real estate. You can go off on a tax advantage basis and do a 5-day trip, as long as you spend at least 4 hours talking about business and real estate, and you could write that off if they're on your board of directors. So plan ahead, and you can leave on a Thursday, do 4 hours plus of real estate meetings, educating your kids about money and real estate in your portfolio. Enjoy Saturday, Sunday, and fly back Monday, and that is a legitimate tax strategy. And what you're doing now is you're beginning to teach your heirs how to manage money, right? You're beginning to empower them so they don't get this big inheritance and all of a sudden have no idea how to do it, because most of us are taking control of our finances, and we want to empower our kids to do that, not have to turn it over to financial advisors that are going to put the money on Wall Street for a 1% management fee. So empower your kids and start mentoring and teaching them now along the way as you're growing your portfolio, and bring them along.
Absolutely. You know, I've been contacted by so many people, and where their parents left them real estate and they just want to sell it. They just want to sell, they want to pay the tax, sell it. And it's like, you know, coming from an investor, I'm like, in my head, I'm like, your parents did not want you to just sell all this. You know, they want you to have that recurring cash flow that they have, but instead you're just going to sell it and take all the tax, you know, and it just, you know, it just wasted away basically all your hard work. But it's because the kids never understood what the parents were doing, and they just want the cash. And if they would have just broken it down, they had enough cash to almost live on to just ride it out, right? But they don't get it. So it's really important that they get it.
Totally. In fact, that's what I say to my kids. Do not sell the assets that I built up. You can exchange them and you can improve them, but don't sell them and liquidate them for cash, because you're going to have to take that cash and put it somewhere. And the sad reality is some people are going to blow it on stuff that's kind of stupid.
And once they get married, their spouses need to understand it too, because they're very influential. So let's talk about practical advice. So for someone that's selling their first investment property that wants to do a 1031, what do they need to know even before listing it?
Yeah. When you're doing a 1031, I think it's really key to kind of plan ahead. You want to call your tax advisor, first of all, and involve your CPA and your tax advisor. Bring them in. Here's what my asset is. I'm thinking of selling it. Here's what I think it'll sell for. And what you're going to do is you're going to find out, this is what I would owe in taxes. And I'll tell you, first off, you might be really surprised. It might be a really big number that you're going to owe in taxes, more than you're thinking. When you add in depreciation recapture, federal capital gain, state tax, and the Medicare tax, which is a 3.8% surtax on net investment income, that's a big tax hit. So first of all, find out what you're facing. The other one you want to look at is, how do I hold title on this, right? Is this in my own name or is it an LLC? What do I want to do? So meet with your tax advisor and have that tax discussion. And it's also important because a lot of you might have different tax considerations. You might have things like suspended carry forward losses that your tax advisor knows about that somebody else wouldn't. So that would be really important. The other thing is just talk to your real estate professional in the marketplace. Get an idea of what the property will sell for. What are the comps? What's going to be a reasonable price? So before you're actually listing it and starting to exchange, do a little bit of pre-planning on the tax side, do a little bit of pre-planning with your real estate professional to get a good idea of how long are these sitting, days on the market, what's the right price, what's the comp, and that'll give you a good feel for what your property will actually sell for. So both of those considerations, tax and the market, do both of them at kind of the same time. A lot of people do the real estate side, but they forget the tax, or they do one or the other. But I would say combine those two things together.
Yeah, absolutely. And have your properties that you're interested in identified, right? Even when your property is for sale, because you want to be ready to, you have to identify the properties within 45 days. So you want to, in the bag, know what you're looking at buying before you even sell your property.
Absolutely. Yeah, and you guys, the 45 days, that's set in stone. You don't get a wiggle room because the market is really frothy and they're turning over. So the tax code goes through different, it doesn't change with the economic cycle. So when we've got a really frothy market and things turn over, you have the same 45 days. When the market's a little soft and kind of like it is now, same time period. So you have till midnight of the 45th day. You cannot identify anything after that. So you either meet that deadline, complete your exchange. If you don't, then by default now you've converted it back into a taxable sale and you'll owe taxes.
And if you're working with a realtor who doesn't want to show you places until your place sells, you need to find another one. All right, so how soon should an investor loop in a 1031 professional when they're going to sell their place?
Yeah, so you've got to set up your 1031 exchange before you close on it. So your deadline would be, you must set it up before actually closing. You can't close and come back a day or two later and set up a 1031. So that would be the bright line test. In a perfect world, you're also going to, so I mentioned tax professional, real estate professional. You want to also contact a 1031 expert somewhere in that listing process and have them explain the rules, the time deadlines, the ways to identify property. That way you really kind of know the market, you know the tax side, and you know what the 1031 requirements are. Even those of you, a lot of hands went up of doing exchanges, but if it's been a few years, you might be a little fuzzy on the exact rules. How do I identify? So get that refresher from the qualified intermediary, the 1031 expert, as you're going about it, so you've got all those rules in front of you and you know what's kind of going on, because they don't change that much, but what you did 10 years ago, you might be a little fuzzy on exactly what those requirements were.
Yeah, and as you want to tell your realtor that you're doing a 1031, you also have to understand that most or a lot of real estate agents don't really know what that is or how it works. So you also need to make sure title understands that the proceeds of the sale need to go to the 1031 and not to you, because if it accidentally hits your bank account, there's nothing anyone can do about it. So, Scott, do you think 1031 exchanges will still be around in 10 years?
Ooh, that's a tough question, but the answer is I do think they will be around. They've been around for 104 years, and I think they'll be around. 1031s get attacked depending upon different presidential administrations. It looks like a way to pick up some tax revenue. There's a lobby that I'm involved with where we educate people in Congress on why 1031s create jobs and they create real estate transactional activities. So they help out real estate professionals, title companies, lenders. The fix-it man who's going to paint your house before you sell it, they get employed because of 1031. So on the commercial side, you've got people that do phase one environmentals, and all of these people, 1031s represent close to 1 million jobs. That's what's involved with the 1031 exchange. So once we educate people in Congress, regardless of their political party, that it's 1 million jobs and that it drives the economy, most of them understand that, and most people want to have good jobs. They want to have a healthy real estate market. So it's a continual education process. So I think somewhere down the road, they'll come under attack. And I think the real estate industry and some of the educational lobbies will try and educate people in Congress. And it's a constant battle. I mean, we've been doing this for lots of years.
Well, the other thing that they do is they make investors sell their property. Because if you didn't have 1031s, people aren't going to be selling their property because they don't want to take the tax hit. Exactly.
We call it the lock-in effect, right? Mm-hmm. If you bought an asset for $200,000 and now it's worth $2 million, if you don't have a 1031, what are you going to do? You're not going to sell. Realtor's not going to be paid. Title company's not going to get a fee. The lender's not going to get it. it would slow down the real estate market. And I'll tell you the area that'd be really crushed, the commercial market, something like 30% of all commercial transactions involve an exchange. It would crush the commercial market, but also think of areas where there are vacation properties, Lake Tahoe and all these mountain areas and resorts. A lot of those are qualifying 1031 properties. If you took 1031 away, all those vacation homes, they would just sit on them. So 1031 is throughout the economy, right? It's residential, it's commercial, and it's everything in between. It's really a big driver of deals out there.
So how should investors be thinking about their portfolio in 2025 versus 2015?
So right now with your portfolio, you've got to realize one thing. We're in a long-term game. You don't buy real estate to get wealthy in 2 months. You do it to get wealthy over 5, 10, 15, 20 years. And I think right now in the market, it's challenging. Property taxes are up. Insurance is up. Rents are up a little bit, but the cost of operating a property are up a whole lot in the last few years. The cost of repairing with inflation and labor. So the costs are up. The way to look at it is you're buying one of the best and most reliable asset classes historically that has created more millionaires than any other asset class. But that doesn't happen in a year. It's going to happen in a decade or two. It's a long-term hold. So I think what you've got to do is not look at the market as it is today, but realize I'm building wealth long-term. You've got all these different factors that are working for you, right? You're paying down your mortgage, so you got a little principal build-up. Your tenant's actually paying down your mortgage. You have a little bit of cash flow, maybe not as much as you want, but you got a little. You got leverage with the bank. You've got tax benefits. You've got all of these different economic variables that are really working in your favor. And when you combine all those together, it really is a big wealth creator. But you don't make money in real estate short term, you make it long term, and it really works in the background.
Absolutely. So Scott, what's one blind spot you think real estate investors have right now?
I would say right now, one of the blind spots is just what I kind of brought up. People are looking at the immediate market, and they're not looking at this as being really one of the best buying opportunities right now. So I would say take advantage of this. If you've got an asset with a lot of equity and your return on equity is low, consider upgrading out of that and tying up a really good asset. You can always come back, right? Marry the asset, date the rate. You can always come back later and refinance that and do that. And I'll tell you, I do that personally. I probably have 20 plus assets with rates that are a lot higher than I want, but I've got good assets. And I'm going to come back later. Rates will come down sometime. I don't know when. And when they do, then I'm going to go ahead and refi, boost my cash flow position, and lock in long-term financing that I want to hold for the long term. So the blind spot would be not realizing that I think we have a buying opportunity, and just because the market's kind of flat, someday when the rates drop, it's going to pick up and demand will pick up. So we have this sweet spot right now, I think, in the marketplace to scoop up great purchase opportunities, build your portfolio now, and you'll be so happy you did it and you picked up things that when it gets frothy again, you're not going to be able to touch them. And so just look at it that way.
Yeah, it's so frustrating with buyers right now because they all think it's 2008, right? Oh, I'm going to wait. I want to wait. I want to, wait for prices to come down and prices to come down. And really what I'm seeing on the real estate side is sellers, some sellers are desperate. There's not very many, but you have some flippers in the middle of flips. You have some divorces. You have some relocations. And there's times to get a good deal. You just have to negotiate the good deal. If it's, if the property's $600,000, don't wait till they lower it to $550 to make an offer. Make a $550 offer and see if they'll take it. And so many buyers are like, well, I want to wait, or what if it goes to 500? It's like, this is not 2008. Like, get your good deal now, because as soon as rates go down, it's going to bring people out in droves. Right now, the buyer has all the power. So don't wait until it's more of an even market and you lose that power.
Yeah, I totally agree. And the thought that Danille said there is really important. People look at prices, right? I want prices to go back to what they used to be. That train left the station because of inflation. Like it or not, learn to use it properly or not, the dollar doesn't go as far. And so the number that you saw 10 years ago that you think feels like a good number, That number is never coming back. We have what we have today. And the way I look at it, there are good buys out there. Look at the marketplace, do your analysis, pick up a good buy now, because we're going to look at this, I guarantee you 10 years from now, when we're in 2035, we're going to go, man, that property at 550, that was a steal. I should have bought it at 550, because now it's going to be 1.5 or whatever the number is. So look at it that way. I'm telling you, this is a great buying opportunity.
In 2016, I was buying a home, and it was $230,000 in Scottsdale. And I told Ken, I was like, this is a little out of my price point. I was trying to stay closer to 200. He's like, no, like this is a very good deal. You have to buy it. And the one down the road was also for sale for 230. And I said, no, I'm just going to buy the one. Well, it was good I bought the one, but biggest regret, because now they're about 550. So there you have it. And Scott's going to tell you a little bit about his company if you guys are interested.
If you want to talk more, just track me down, Coach Scott at Wealth Outside of Wall Street, and I'll be happy to help you out. So thanks.
Thank you.